Which scenario for the United Kingdom? Financial markets have become very used to the BOE in raising bank rate. It has done so at every policy-setting meeting since it began the current tightening cycle last December 2021, and expectations are that Thursday's announcement on the 22nd of September 2022 will make it 7 out of 7 voting. However, there is still a widening split between the doves and hawks, mean that the size of the increase is much less certain. A 50 basis point increase would put bank rate at 2.25%, its highest level since December 2008, and would be only the second time that the bank has moved this aggressively since February 1995. A 75 basis point tightening would be the largest since so-called Black Wednesday in September 1992, when the bank tried, and failed, to keep the pound in the exchange rate mechanism, ERM, of the European Monetary System, EMS. Updated information: public sector net borrowing excluding public sector banks, PSNBX, was £11.8 billion in August 2022. £2.6 billion less than in August 2021, but £6.5 billion more than in pre-coronavirus, COVID-19, August 2019, when it was £5.3 billion. Central government current, or day-to-day, expenditure of £73.2 billion in August 2022 was largely unchanged compared with August 2021. With a £1.5 billion increase in debt interest payable, a £1.7 billion increase in payment for goods and services, and a £1.1 billion increase in net social benefit payments being offset by reductions elsewhere, including a £3.4 billion reduction in subsidy payments. Central government debt interest payable was £8.2 billion in August 2022, £1.5 billion more than in August 2021, and the highest August figure since monthly records began in April 1997. The volatility in interest payable is largely because of the effect of Retail Prices Index, RPI. Changes on index-linked gilts. Central government receipts were £69.6 billion in August 2022, which was £5.6 billion more than in August 2021. Of this, tax receipts were £51.4 billion, which was an increase of £3.9 billion compared with August 2021. PSNBX was £58.2 billion in the financial year to August 2022. This was £21.4 billion less than in the same period last year, but £30.4 billion more than in the financial year to August 2019, pre-coronavirus pandemic. Central government net cash requirement, excluding UK Asset Resolution Limited and Network Rail, was £4.9 billion in August 2022, which was £3.6 billion less than the £8.5 billion cash deficit in August 2021. This brought the total to £29.4 billion in the financial year to August 2022. Public sector net debt excluding public sector banks, PSNDX, was £2,427.5 billion at the end of August 2022, or around 96.6% of gross domestic product, GDP, which was an increase of £195.2 billion or 1.9 percentage points of GDP compared with August 2021. Public sector net debt excluding public sector banks and the Bank of England, PSNDX-BOE, was £2,107.4 billion at the end of August 2022, or around 83.8% of GDP, which was an increase of £113.8 billion but a reduction of 0.8 percentage points of GDP compared with August 2021. On the news released information about the public sector finances, there is still a widening split between the doves and hawks, mean that the size of the increase is much less certain. On the side of the dovish of BOE, at the August meeting, the sole dissenter calling for only a 25 basis point hike was Silvana Tenreiro. She suggested she still has little enthusiasm for a sharper move, emphasizing instead that a widening output gap and rising unemployment are likely to weigh heavily on domestic inflationary pressures. She also pointed out that as bank rate moves closer to the neutral rate, smaller changes would be all the more appropriate in order to avoid excessive tightening that would put added downside pressure on the real economy. On the contrary, for the most hawkish members, Catherine Mann, worried that the action taken so far has not tempered inflation expectations. This suggests that she might fall into the 75 basis point camp. Consequently, another, possibly wider, split vote on rates is very likely. In any event, financial markets still expect 3-month SONIA, sterling overnight index average, to climb sharply over coming months, rising from about 2.6% currently to nearly 4% by year-end and above 4.5% in the middle of 2023. This week's meeting will also see a decision on the proposal to begin outright sales of QE gilts. So far, the only active QT has been restricted to corporate bonds, which are in the process of being gradually whittled down from a peak of £19.99 billion, with a view to being fully unwound no earlier than the end of 2023. However, subject to a confirmatory vote, the bank is aiming to sell £10 billion of the gilts every quarter as part of its plan to shrink its balance sheet by £80 billion a year. That said, sales will be subject to economic and market conditions being judged appropriate, and that could now be an issue should investors struggle to digest the huge additional issuance needed to fund the government's emergency energy support scheme. This aside, any shift to a more broad-based QT program would of its own accord tighten the policy stance still further. Crucial to the future interest rate profile is inflation, but, in the wake of recent developments in the energy markets and the policy responses at home and abroad, the outlook has become even more uncertain than usual. Russia's decision to essentially turn off its gas tap to Europe has provided a fresh underpinning for energy prices, but G7 plans to cap prices and, in particular, the UK government's new price freeze all make for a very complicated picture. That said, the new emergency fiscal package, estimated to cost around £170 billion or more than twice the size of the COVID furlough program, is easily large enough to boost inflation over the medium term. At the same time, businesses are expecting a further acceleration in wage growth. The BOE's August decision maker panel found firms expecting wages on average to climb 5.5% over the coming year. This was up from 5.2% in July and 4.4% in May. Of note too, based on the BOE Ipsos survey, public satisfaction with the central bank's control of inflation also fell to its lowest mark since 1999. Adding to the inflation problem too is the weakness of sterling, the currency losing 4.4% versus the dollar in August to realize its worst month since late 2016 in the wake of the Brexit referendum. Indeed, current levels are amongst the lowest in the last 37 years. The inflationary boost from the exchange rate will be one factor in any vote for 75 basis points on Thursday. Indeed, both businesses and, in particular, consumers are becoming increasingly worried about the future. The latest figures suggest that recession could arrive sooner than the BOE expects. Whatever the bank decides to announce on Thursday, it is unlikely to feel overly confident that it has done the right thing. As it has freely acknowledged for some time, the economic outlook has become highly uncertain, and the latest developments surrounding energy supplies and prices have only made it more so. Inflation is high enough that bank rate must surely be raised again, but since its peak may now be well below what previously seemed likely, both the appropriate speed and extent of future tightening are all the harder to judge.